Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hello, everyone. Welcome to the latest Carson's Facts versus Feelings. Ryan and Sonu here, almost coming to us from the same state, I guess, right?
Yeah, same state, yes.
Same city, not the same state. This
the
is
Buckeye
episode...
State.
Yeah, there we go. The Buckeye State. We'll talk about it. Episode 97, everyone. We're inching closer to 100. We're calling this one, What Is It About August? Now, before I even get there, Sonu, that's a famous quote. Let me make sure I read this correctly here. From George H.W. Bush, after his second consecutive summer vacation was disrupted in August. Remember, in August 91, Iraq invaded Kuwait. And in August of 90. August of 90, Iraq invades Kuwait. And August 91, the Soviet Union had its coup. And anyway, ruined his vacation 2 times in a row. And here we are in August. We're going to get into all the details.
It did ruin. I can't say it ruined my vacation, but I was, look, just so that everyone knows, I am on a 1-month sabbatical. Yep. And so I was in Europe, and suddenly I was like, markets are going, hey, it's funny. My friend who's totally into crypto and said, like, dude, so the markets are crashing. I'm like, Wait, what happened? And I totally switched off. And then I was like, I need to get in touch with Ryan. And next thing we know, we're doing calls and, but it was fun. It was good.
Yeah, well, the joke is you're not allowed to leave anymore because you've left and it's gone absolutely crazy. That's what we'll talk about. I think a lot of people take vacations. We'll get into that kind of why. But so where are you? I'm obviously in Cincinnati. Where are you sitting right now?
I am in Columbus, Ohio. Not too far from the stadium, actually. Yeah, no, my in-laws are in Upper Arlington, so I'm here. But so both not working except for doing the podcast, I guess.
No, you've done good. I thought you've done well, but out of the country is probably harder to work. Now that you're back and things are going on, I bet you'll be paying attention. I know CPI comes out tomorrow, but I mean it'll be out by the time most people listen to this, I assume. But I'm sure you'll be itching to look at the CPI.
Oh, for sure.
That's what I know. You're a geek. It's one of your favorite things.
CPI, already looked at PPI this morning.
Exactly. You can't say no. So well, let's get into it. I know we've got 35, 40 minutes. So what do we have? About 35 minutes here.
35 minutes.
Pretty hard stop. So let's just dive in. I mean, so let's start with the markets, right? A week ago right now, we had pure fear, right? Absolute fear. The S&P fell more than 1% on Thursday, Friday, and then last Monday. 3 consecutive days, 8.5% closing basis. Mini mild pullback, nearly 10% intraday. Not quite, but it was pretty close.
And the Nikkei was down. The Japanese index was down 20%. And then it rallied after that.
In 3 days. I mean, the Fed, we talked about this in the podcast last week, and hopefully everyone had a chance to listen to this. Honest to goodness, I forget what we titled last week's podcast. But we had Barry on the team, Grant on the team, Sonu, myself. We did a very special aftermarket call last Monday with a lot of opinions. But what do you want to talk about? There's so much to talk about here. You want to start with kind of August?
Let's talk about August. I mean, the markets went down, and then Thursday was the day of the big rally after unemployment claims came out. I mean, I could quickly cover it. Look, I think part of what happened last week, or I guess however we are talking about, with the market drop, part of it was like we got a soft payroll report. I think one thing that happened is a lot of people had, let's say, just to make this simple, zero probability of a hard landing. Right. And once we got that payroll report, and you and I have talked about the Fed being behind the curve. Right. Combine that with the fact that maybe, the unemployment rate is going up. That's not a good thing. Whatever the reason for it is, irrespective of it. I think the probability of hard landing in investors' minds may have shifted, which is not to say it's a base case, but maybe instead of 0%, it's now 10 or 20%. Right. And that's probably, a bit of a growth scare that we got. And then we got unemployment claims data on Thursday morning, which I think you've asked me in the past, sort of what's your favorite leading economic indicator? I said, I don't have one, but if I had to pick one, I would pick initial claims for unemployment benefits. And that one tells us like the labor market is still okay for now, right? And markets rallied. It was a big 2% up there or something.
I believe a 2.3% update for the S&P on Thursday. About 87% of all the stocks in the Russell 3 were higher, so pretty broad-based rally. It was the best day for the S&P since November 22, and don't forget we had the worst day on Monday since I think September of 22, but that's normal. I mean, our friends at Bespoke have done some studies on this. The best and worst days are normally like right by each other, right? Because that's when you tend to see the most volatility. Just a little color here. I took a look when you have a down at least 1% Thursday, Friday, Monday. Okay. Like, again, we just saw, last week there. 3 months later, higher almost 10% on average. I'm sorry, higher almost 10% on average, but up about 90% of the time. 1 year later, higher 18 out of 21 times, up 22% on average. So, listen, yeah, a lot of studies do suggest stocks tend to go higher. I get that. But the other thing is when you have volatility, you have weakness, you know what tends to happen? Things do okay. I want to talk about the VIX for a second. What is the VIX? Right. The fear gauge. It's a very complicated formula, so we'll just leave it at that. But it's trying to gauge volatility in the options market 30 days out. Keep it simple. When the VIX spikes, and you will turn on TV, you heard all about this. When the VIX is up around 40, 50, 66, like it was last Monday, that's a lot of fear. That's a lot of volatility. Sonu, I looked at all the times using FactSet data that the VIX is traded above 50 intraday. Okay. I found 92 times. This recent one was the 93rd. Last Monday was 93rd. Looking at those other 92, the S&P 500 was higher a year later, 91 times. Wow. Now, let's be clear. A lot of those all happen in clusters. Totally get it. But at the same time, longer-term investors, how do you reach your long-term investment goals? We work with financial advisors every single day and their clients. It's not by panicking and selling when things go on sale. I'm not saying it's by loading up when things go on sale either. I'm just saying it's sticking with your process. If you have a 401k, hey, a lot of people just bought stocks, but they're cheaper than they were a week ago, right? Or don't panic sell. But again, have that plan in place, right? Plans are useless. Planning is everything. President Eisenhower told us that a long time ago. To have these plans, and listen, VIX spikes happen. But here I want to ask you this, because I don't know the answer to this one. The two previous largest VIX spikes ever were the Great Financial Crisis, the GFC, and March of 2020 when COVID really hit. And then Monday. Monday was sparked because the Bank of Japan hiked interest rates like 25 basis points. Okay. So you've got the worst financial crisis in our lifetime. You've got the worst 100-year pandemic ever. And a central bank hiked rates by 25%.
25 basis points.
25 basis points. Oh, 25% might do it. You're right. 25% might have done it. 25 basis points. That's why we do have a two-man show around here.
0.25%.
What in the world? I mean, it's like the most ridiculous market crash I think I've ever seen in my career. Now, maybe in Japan when they were down 12%, and I get it. We get it. It's because of the carry trade. But 25 basis points, I can't even wrap my head around it. Now you see Bank of Japan, and honestly, I think Thursday's rally had a lot of Bank of Japan brought a big eraser out and said, oops, our bad. We're not going to do that again. I know we kind of said it was claims, which were fine. But the Bank of Japan also said, we're our bad. And markets are now readjusting to that little bit of change in the carry trade. But I don't know. I just said a lot. What's your take on why we just freaked out when the BOJ did that?
Look, we've talked about it. Markets have been quiet for a very long time. Right. And I put this down this episode. Yes, COVID is obviously a recessionary time. Sure. It was a crazy time. So it's not that unusual that the VIX spiked as much as it did.
You remember those headlines back then? Yeah. Trust me. I think the VIX should have been higher. It was pretty darn scary.
And same thing, even in 2008, the recession, I think it started pretty clearly at the end of 2007, right? Housing is in downturn, all of that. Yeah. But what led to the big spike, it was, everything that happened to Lehman and then AIG after that. And then October with TARP being voted down and then voted in again, all of that. That's when the Dow was down, more than 600 points, 666 points, something like that, right? This is way back in 2008. I put this episode more down to something similar to what we saw, was it February of 2018? When the VIX spiked.
That was one of the other times. August, so the Great Financial Crisis, COVID, and then August of 15, that was another VIX spike above 50. Well, that was one of them. That was the yuan devaluation, kind of similar to what we're seeing now. Yes. And then Volmageddon, as we called it, early February 2018, when the trade war started, but we also had very low volatility into that. Those are the only times in history a VIX spiked above 50.
Yeah, so I think this gets to the fact that a lot of people were, to put it slightly in technical terms, short volatility, right? What does that mean? They were selling volatility, right? Because volatility is very cheap. The more you sell, the cheaper, it gets. When he starts to sell something, the price continues to go down, right? When a lot of people are selling, a price goes down. So volatility is basically a price. It's a price of insurance, basically, in a sense, right? And when the VIX spikes, that means more people are buying insurance. But most people are selling insurance. That's what was happening before for the 2 months going into this. And I think it was Buffett who says, when the tide goes out, that's when you see who's swimming naked. And what happened with this was a lot of people were extended, right? And because of that volatility, when one thing stretched too far on one side, you just need a little catalyst, right? And suddenly things swing the other way. It's just interesting, back to your point about how we started the pod. Like all these things seem to happen in August. But I think part of the reason is, June and July tend to be quiet. Everyone's out for vacation, right? And so you don't need much of a spark to send things in a crazy direction. And we've seen that in August of 2015 with the China devaluation of their currency, yuan, right? And several other August episodes. But I think coming into it, we've just been short volatility. Volatility's been really cheap, and little spark, boom, you're off to the races.
What's the old Chinese proverb? A tiny spark can start a large prairie fire, I believe. And that's kind of what we saw. Now, here's some more color behind August. And again, the title of this week's podcast, There's Something About August. I wrote a blog, which will be carsongroup.com/research. I was trying to tie in something about Mary. I couldn't do it. So I just went with There's Something About August, because again, that quote came from a former president. But Iraq invaded Kuwait in 1990. This is month of August returns. Okay. These are all these random, I'm going to say air quote, random events in August, down over 9%. The Asian contagion, remember that time in 1997, down 6% in August. Russian default, which led to long-term capital management. Remember, they had two Nobel Prize winners on staff. Well, that didn't work so well. That went under in, I believe, October. But in August of 98, a year that if you think back to 98, I think, wow, stock market did great, because it did. Down 15% in August of 98. Then we have the European banking crisis really gripped in August of 2010, down 5%. Who could ever forget the U.S. debt downgrade, where stocks dropped darn near 20% in about 4 days. But for the month of August, down 6%.
That's 2011, right?
2011, what did I say? I meant to say 2011. 2011 U.S. debt downgrade. Then we have I think quite similar to now, the surprise Chinese yuan devaluation. I remember this. I was unemployed at the time. I had very, very serious back issues. I remember being at the doctor. Okay. And I guess we had phones back then in 2015, or maybe it was on TV. I don't know. It's probably on TV. Anyway, I'm sitting there. I can barely walk. I'm unemployed. I just feel terrible. And on TV, Dow down 1,000 points. Now, back then, 1,000 points was a big deal. Okay, now 1,000. Believe me, if it's down 1,000 a day, it still hurts. But that was a bad day in my life. I was like, God, this is terrible. Now here I am 9 years later, Sonu, talking about you, and
the Dow is at 40,000.
Exactly, bring them on. We can handle it. But anyway, that month, and so just to put context around this, that was a much bigger drop back then. We were down 6.3% in August back then, and as of Friday this month, we're down ballpark 4%. We had one of the worst starts to a month ever. Not surprising. I just mentioned down 1% the first 3 days at least. So, long way to go. But I guess the bottom line for the listeners, but we've been telling our Carson partners, did we expect a calamity this August? No. If you listen to this podcast, we weren't saying that. But the fact it's happening, we have to at least realize that these things happen. And I'll let you talk in a second, Sonu, but I think a lot of it has to do, and smarter people than me say this, in August, a lot of the big guys and gals aren't working. They're at beaches. They're all over in Europe. They're over in Greece. And then you get these events, and it's like the B team's there, and you get more volatility. Everybody's freaking out, and things are a little more amplified, right? And then by the time you get a little deeper in, calmer heads prevail. And I know it's a different world now, because we all can work from our phone pretty much anywhere. I mean, let's be very clear. At the same time, I think there could be something to it, or I love what you said, usually light volume, and then boom, not so light volume, you get volatility. Anything to add on that as we move forward?
No, I think what the A team, before taking off the summer, they've gotten into all these trades that were short volatility.
Good point.
And then they've gone to the beach or the Hamptons or wherever, or, and suddenly it's not like there's always a spark, right? Usually, like last year, I think August was fine, right? Then nothing happened.
Sure.
And maybe even 2020. Well, 2022, we are all worried about the Fed. So there was a lot happening in 2022. But, this year we got a spark, and suddenly things had to unwind, and suddenly these guys were, probably making calls from their vacation.
Oh, I'm sure they were. Yeah. I'm sure they were.
But I wanted to, one more thing, right? Here's the other thing. We talked about it briefly last week about bonds coming back. And, like in our case, you and I manage portfolios along with Barry and Grant, who we had on the podcast last week. And we've been talking, even in a mid-year outlook, we've been talking about risks rising. Doesn't mean we don't like equities. We haven't reduced our equity overweight, right? But we've increased our hedges. We've been doing that for a while, all the way back from what was it, April?
Well, we added gold March of 23. I mean, I
right.
looked at that kind of like a hedge, to be honest.
Exactly, and gold,
which by the way, hit 2,500
Yeah.
yesterday, the quietest all-time high ever. So gold's been working out very well for a diversified portfolio.
Right, and I think when we had a mid-year outlook call, we talked about one of the risks being the Fed being behind the curve.
Yes,
right. And this was well before this last 2-3 weeks when everyone suddenly realized, oh, maybe the Fed is behind the curve. When we talked about it, everyone is talking about stagflation.
Yes, they were.
So, but no, we've been adding bonds for a while. We've been increasing the size of our hedges in the portfolio. And at the end of the day, look, it's not like your hedges, whether it's bonds or whether it's other diversified managed futures, commodities, will work all the time. You want only one of them is likely to work in deep crises, right? If it's an inflationary episode, maybe commodities do well, managed futures do well. If it's an issue, a growth scare like we got recently, bonds do well. And that's why you want to have a diversified portfolio. We've been aware of that. I mean, so I think all I'll say is I feel like we were prepared going into this.
Yeah, you never know when it's going to happen. But I mean, I on this very podcast, I'm sure you can find it. I've been saying we'd be naive to think in an election year, August, September, October, we're just going to be easy. I mean, I know when I'm talking about the election, there's other things going on. And obviously, I mean, listen, the headlines are the headlines. There's a very good chance Iran is going to strike Israel. And who knows, that could be happening by the time people listen to this. So let's just hope that
and oil prices have been slowly ticking up almost every day this past week. I don't know about today. Today, I think it's down a little bit.
Yeah, flat. But I mean, so we'll just see. How all that shakes out. That's clearly going to add more volatility in a region that doesn't need any more. But I did see the Israeli stock market's one of the best performing stock markets this year. I don't
so
have
there you go.
We'll just drop it there. But I mean, that's interesting.
Actually, I have one question on this. I think I saw a clip of you on CNBC. You were talking about.
Oh God, what did I say? Don't believe it.
No, like speaking of trades that were stretched, right? People are all gone one way, short volatility, and safe to say maybe everyone is like, oh, growth and tech and AI and all of that. But you and I, we've been talking about the rotation. I'd love to get your thoughts on the rotation trade, even going forward, given everything that's just happened.
Yeah, I mean, bottom line, we'll talk about the economy here. We've done stocks here for a while in the markets. We'll talk about the economy, but we still don't see a recession. I mean, second quarter GDP was 2.8%. The Atlanta Fed GDP now is looking at darn near 3% GDP. I joked on X a little bit ago. It's the best recession ever continues. So if you don't see a recession, we still think we like industrials. We like financials. We like SMID, small and mid caps. Those are some of the bigger overweights that we have. But financials and industrials, I think, are interesting. I mean, you break down industrials, there are a lot of railroads. Okay, I mean, look at I can't give a recommendation necessarily, and I'm not, but look at railroad stocks. They are breaking out. They look like AI stocks from 6 months ago. Okay. I mean, that's not a bear market. That's not a recession when railroads are strong. And then you can look at FedEx and UPS. Well, you can tell any story you want. The UPS has struggled. FedEx has done amazing. I mean, so you can say, oh, the shipping industry, and you can give the story you want. Okay. It's like Walmart. I joke when
Walmart's earnings are coming out this week.
It doesn't matter what they say. It's spun either way. Because if it's strong, well, that's a weak consumer because everybody's buying it. But if it's weak, well, I told you the consumer is weak. So anyway, the media's got that all. They've got two stories written up to go. But the bottom line, I think the rotation trade is still here. I mean, we're going to see blips where tech comes back. We're more neutral tech. Nothing wrong with tech. I mean, that's where the earnings growth is coming. It just got a little too extended. Just got a little too excited. And last week when we had, we were promised a recession, promised a bear market, industrials and financials were up last week. Okay. They led. And we think those groups can continue to lead. Regional banks, I think somewhat quietly, they were up almost 20% last month, kind of consolidating now. You don't see 20% up moves at the end of a bull market. You see 20% up moves at the start of a new higher move. And let's be honest, regional banks and biotechs are two of the bigger parts of small caps. So if you see some leadership there, I don't have a strong opinion on biotech, but regional banks to me, hey, that's still pretty darn strong. Now, so also what caught my attention, just a drop in sentiment. And my buddy Joe Fahmy, I hung out with Joe last week in New York. He was on the Compound and Friends with JC Peretz on Friday. Definitely listen to that. Joe pointed out just how quickly sentiment changes. Now, it used to take like months. Now it's like, days, weeks might be long, maybe hours in some ways. We all have our phone and we're connected. But the AAII, American Association of Individual Investors, number of bears had its largest 1 week jump ever. Oh, no, not ever. Largest 1 week jump since November 22. Not too surprising if you ask me. And then the Investors Intelligence was just a newsletter, had a 2 week drop in bulls, the largest drop in bulls over 2 weeks since after the 87 crash. Volatility spiked. Put to call ratios are spiking. The CNN Fear and Greed Index is in extreme fear, or extreme greed. Extreme fear. Sorry, extreme fear. Yeah, I'll get there. But there's other instances, and I'll just use the old panic among family and friends indicator. I don't know about you, but
sure.
I had a lot of texts, a lot of calls, a lot of people worry, a lot of people kind of mocking. Like I got a couple Facebook messages. I don't use Facebook Messenger. Okay, I got someone there, and they said something like, "Oh, ha ha ha, your stock market, like my stock market." Like it's our stock market, it's not my stock market. And this is on Monday, and I'm just kind of like, "Oh God, this might be the lows." Like when this random person out of the blue starts calling me out because the market's down like 3% after a 50% rally, you're calling me out. So anyway, and now sure enough, here we are. Anything else you want to talk about on markets before we kind of talk about the economy going forward here?
No, I think we covered it pretty well, and we still,
I think so too.
And to underline it with the rotation, we still think there's more rotation in play here going forward.
Yeah, no, well, so I'm just trying to see. One other thing that it scared a lot of investors, and rightfully so. The news came out over a week ago that Warren Buffett, or at least Berkshire, but I just maybe say Warren Buffett, sold about half of their stock in Apple, right?
Interesting.
They had, I can't even read my own writing, but just know he sold about half. He sold about half of his stock in Apple, and the cash, that chart was going all over the place, how much cash Berkshire had versus previous times. I've got it written down somewhere. I can't find it. But I mean, it's much, much higher than any time in history. So, that brought the worries along with the Fed, along with the potentially slowing economy. But we're going to talk about that next. We're not so sure about that.
By the way, who may have gotten hit, just on that, going off on that tangent, who may have gotten hit hard by Japanese stocks being down as much as they were? Warren Buffett. Because remember, we've talked about it before. I think with Jeremy Schwartz, because Buffett, bought Japanese stocks, and he didn't buy Japanese stocks with his cash. He borrowed money from the Japanese to buy Japanese stocks. So he was like, it was like a leveraged play, right? I mean, he's got cash to back it up. Obviously, there's that cash hoard you talked about and other various sorts of collateral. But, obviously we don't get to see Berkshire's books every day, but it would be interesting to be a fly on that wall that last week when Japanese stocks were down 20% to see like what was happening at Buffett's positions. Wow. Of course, Japanese stocks are back up. They're down, quote unquote, only about 10% or something like that since then. But yeah, sure. Buffett was somebody who was really leveraged into that trade.
And for several years,
adding
and accumulating in Japanese equities. Good point.
His Japanese stock holdings have done better than Nvidia. That's how well he's done there. So.
Okay, well, that's pretty good. That's pretty good. The one final thing, looking at sentiment and markets, our friend Jim Paulson, he's back. He was at Wells Fargo and has been around, but he semi-retired. But Jim's back, so follow him out there. He noted. Consumer confidence, this is the Michigan consumer confidence.
Okay.
Recently was at the same level now as it was at the start of these bull markets, the 75 bull market, the 80 bull market, 82 bull market, 1990 bull market, 2009 bull market, and then the lows of 22 in equities. So, we're not that far from all-time highs. Okay. I mean, last month we closed an all-time monthly high across the board, right? I mean, to see this is just truly amazing, and maybe it's social media, maybe it's a division that's out there when it comes to the election and politics. I don't know, but it's really fascinating that there's still just doubt that's out there, and I think it's hard to say this bull market's going to end when so many people continue to doubt it. All right, so let's talk about the economy. I'll set up and give it to you here. We had the jobs number, which we did dissect pretty well last week. Came in about 60 to 65,000, weaker than expected. Apparently, everybody freaked out thinking that was a weak jobs market. Probably was a little bit more unemployment ticked higher. You've been all over the idea of maybe it's because of immigration and some other things why that's been ticking higher. Bottom line, though, it's like a beach ball. You take it under the water and let it go. When unemployment rate starts to go, it can go. Okay. Yes. I think we saw, the other one was manufacturing. ISM manufacturing, that's very small sample size of purchasing managers said, you know what, we're not doing as much hiring. That also got a lot of press out there. But then last week, we saw the ISM services number came in much better. What else you want to talk about? You want to talk about that, or what else you want to talk about from the economy that's saying we'll push back, I guess, the idea that a recession is imminent? Let's go from there. What do you want to talk about?
And this is where you want to separate, like, there are risks. Risks are increasing. And, we talked about that with respect to how we are positioning our portfolios as well. And we've been seeing this for a while. It's not just last week's data, right? And, but easy way to think about it, the unemployment rate is going up. Usually when it goes up, it tends to go more up. When it goes down, it tends to go more down. It trends, right? I mean, which is not a recommendation to do technical analysis on the unemployment rate.
Yeah, exactly. Right.
Don't do that for, if you're sitting at home and listening to this. But no, the risks are higher. But at the same time, that's not to say the labor market is in a very bad place, right? It's just saying that, and we saw that with initial claims. I talked about this already. Initial claims are where they were, last year, where they were in 2018, 2019. There's something called the insured unemployment rate, which is how many people are continuing to collect unemployment benefits as a percentage of covered employment, right? That's at 1.3%. That's similar to, what it was, last year this time, and we had a pretty strong, well, at least I should say, I'll put it this way, much stronger than a labor market than we have right now. And it's similar to what we saw in 2018, 2019, right? So from that perspective, the labor market is a healthy place, but risks are increasing, which is why you and I have talked about this. The Fed should have already been cutting.
Yep, we've been all over that.
Yeah, so I'll just add this one thing from inflation perspective, because we just got PPI data. Again, nothing to worry about. I'll just put it that way, right? I mean, the story, inflation, like we've talked about, is last year's problem. But listen to consumers too. I mean, all the inflation data we get, people, that's actually all backward-looking data, right? What happened in the past. Forward-looking metrics are inflation expectations. You look at market expectations of inflation, what we call break even, right? Mm-hmm. Nominal yields minus real yields, right? Or what you get on Treasury inflation protected securities. That's about 2% right now. So markets don't think inflation is going to, like in a crazy worrying place. Business expectations of inflation, 2.3%. That's pretty much where we were before the pandemic, only a tick or two higher before the pandemic, 2.1%. In 2018, it was actually 2.3% as well. So this is not like an inflationary environment by any means. And then yesterday, the New York Fed survey came out of consumer expectations of inflation. The 3-year forward expectation for inflation was at its lowest level ever, right? So, I mean, again, I think the inflation problem's over. I don't know what the Fed's looking at, but beats me.
Well, we've been talking about it for a while. I do want to give a shout out to Neil Dutta. I don't think we can have a podcast without quoting Neil. And Neil said this. I thought this was pretty good. Quote from Neil Dutta: "Not all slowdowns lead to a recession, but all recessions start with a slowdown." So that's pretty interesting. And we are seeing some signs of slowdown. I do want to hijack the podcast for a minute, because I just got an email. So I was totally hijacking this podcast. So who knows where we just were talking. We're talking about the labor market, but here we go. We got 10 minutes, right? I'm sure people will enjoy this because it's me just in a frustration. I was in the great state of Texas last week.
Okay.
I got a rental car. It was an EV rental. I didn't even think about it. It was an EV. Okay. So I'm driving this car.
Was it a Tesla? Or
no, it was it's like a Mustang, like a Ford Mustang.
Oh, right. Okay. Like the Mach-E or something. Yeah,
I had to take this car like 150 miles away to 120 miles to a presentation, and did my thing. And it was fun. Like 104 degrees, by the way, last Thursday in Dallas. That was something else. And then I start to drive back. I probably need to get gas. Then I looked, and like, there's no gas tank on the car. And I'm like, well, how do you fill it up? I don't know. Like, call me crazy. Yeah. I don't know how this EV stuff works. And then I realized, oh my goodness, I'm in a car that doesn't take gas.
Okay.
How do you charge it? What do you do if you're in the middle of nowhere, Texas? Because again, Dallas is huge. Yeah. Drive a couple hours away. There's not a lot going on.
120 miles is like a daily commute in Dallas.
So then I realized it's got like this little battery thing. And then I realized very quickly it said like 140, implying my battery had 140 miles left on it. I had 120 miles to go to my hotel. I'm like, oh my goodness. Like I guess if my math is right, that's enough. But what if it's not accurate? What if something happens?
Do I turn the air conditioning off?
Oh, yeah, it's 104 degrees. So I put my head out the window like a dog. No, I keep driving, and unfortunately, it kept going away the way I wanted it to. By the time I got to my hotel, it said I had about 40 miles left, which was fine.
Okay.
But I'm really frustrated. Like, they should tell you. I don't know how to charge the thing. I mean, I'm looking at it. I'm trying to figure out. Like, you got to like plug it in somewhere. I'm at a hotel. I mean, that could have been an issue, but here it even gets better. It even gets better. Next day, I wake up, drop my car off, and I thought it was weird, Avis. I thought it was weird, Avis, that I never got my receipt right away. Okay.
Oh.
And then I realized on Sunday morning, I got a receipt from Avis. I looked at it, it's like $400. Like $400. Well, these EVs, they're supposed to be $89. I looked, Sonu. They said I returned the car on Sunday. I'm like, well, no, I didn't return a car on Sunday. I returned a car on Friday morning. I'm going through our travel company, Advanced Travel, and this is literally from Dominic right now. Dominic said, I called Avis. They reconfirmed the car was dropped off on 8/11 Sunday. Not sure why. That's what the agent said. Maybe you should call. I'm like, I was home on Sunday. Like, what are they talking about? I dropped the car off on Friday morning. So this is proof. I should have never had an EV car. I knew it was a bad idea. I'm telling you, Sonu, I should have avoided it. I'm in the great state of Texas. They give me an EV car. This was not going to work from the start. Anyway, so that's frustrating. Funny. But there you go. So, yeah, I figured you think it's funny because it's Anyway, there we go. But I don't know where we were going with that. The economy.
No, you prompted me. I should probably check my rental. Hopefully, I rented a car in London. Hopefully, they know that I've returned it now.
Yeah. Oh, goodness. Yeah. I got hit with 2 late fees, like $30 a day because it's late. I dropped it off 6:30 in the morning on Friday. Anyway, what were we talking about here? I missed something. Let's see here. Where were we? The ISM services, just to get a little more back on track here. We're back above 50, which is expansion. Remember, our economy is a lot of manufacturers 12%. What is services? Like the rest, Sonu?
Yeah.
Pretty much.
So I'll put so household consumption is about 67 to 70% of the economy.
Right.
45% of the economy is services. So out of that 45, not 45% of the 75, it's 45% period. Right, of the economy is services. So services is almost half. And then you combine services with something like government, which is mostly like services also in a way, right? Because so that's another 18%. So you're talking about 65% of the economy, mostly like services, right? Because household consumption on the services side, and then government as well.
Okay, so that good. Thanks for the color there. So services popped back above 50. Remember, we had a weak number in June, 48.8, came in at 51.4. But to keep this simple, new orders soared, business activity soared, and employment soared. All those soared between approximately 5 points.
Say that again, employment too, right?
Employment, exactly. The one that everyone freaked out about the week before. This kind of quietly came and went. And we're not big on surveys. We like the hard
especially
data.
ISM services.
Especially the isms. But nonetheless, I thought it was interesting. We freaked out on one that's like 12% of the economy versus the one that's 45% of the economy. And light vehicles. I know you love looking at this one. I don't know if you saw this. You travel. And light vehicles up 4.2% in July to 15.8 million units, which again recovered all of the cyber hack that we had the month before. So some good stuff there. What else on the economy we want to talk about? Or want to talk about earnings a little bit, or what do you want to talk about here?
Earnings have been about 13% year-over-year growth.
It depends on your source, but it was supposed to be around 9, and now we're between 13, 11, 12. I mean, somewhere around there, but better than expected again.
Yeah, better than expected, which is not too surprising considering if you take GDP growth. I think everyone thinks about real GDP growth. What actually matters for profits is nominal GDP growth, right? And nominal GDP growth is clocking in around 5% right now. Yes, it's slowed down. And this is where we think like things have really slowed down, right? Nominal GDP growth a couple of years ago was running close to 10, 11%. Last year it was 7.5%. Now it's about 5%. So there's a slowdown there. But 5% nominal GDP growth is higher than the average from the last decade, and that's a pretty good environment for profit growth.
No, good takes there. I do want to give you a shout out, Sonu, because when everything was falling apart last week, it's a good shout out, I swear. It's not like you're treating me like Avis would treat me. You're treating me better than that. I don't know. Anyway,
I was out.
No, but you pointed out when things were really, really, pretty scary. Listen, when we went to sleep 2 Sundays ago, World War III was trending and Japanese stock market was crashing. Our markets are crashing. It was not an easy night for a lot of us for a lot of reasons. Come in Monday, just a bloodbath out there. But fortunately, we've come a long way since then. You pointed out that the U.S. dollar was actually weakening a little bit. There was strength in the Mexican peso. What was the other one? Mexican peso,
Brazilian real.
Like, that is not consistent at all with a risk-off environment. A pure risk-off environment, the U.S. dollar would soar. And those other ones I just mentioned probably would not get much of a bid. Now, yes, a lot of this had to do with the function of what was going on with the yen carry trade. We get it, but I just still think the dollar would have more of a bid.
Yeah.
And here we are, 8-9 days later, things have really calmed down. And I think that U.S. dollar call you had was accurate. You want to add anything to that? We've got about 5 minutes.
Yeah, that's usually my go-to for any risk-off periods, right? Is risk-off really blowing, or like meltdown, right? Maybe that's a way to think of it. If there's a meltdown, like, okay, is this really risk-off? Is it something else like Volmageddon? I think this is more a volatility event. That's how we started this podcast out. It wasn't really, it's crazy to think about. It's not risk off because people are obviously selling stocks. So it's like
selling everything.
Yeah. In that sense, it was risk off, but it wasn't your classic like risk off. And like, yes, bonds got a bid, yields went down, but the safest asset is the US dollar. Now you can buy different things with the US dollar, but yeah, US dollar usually gets a bid during global sell-offs, and it didn't this time, and that was interesting. And all these EM currencies were doing well. I was like, wait a minute, that doesn't comport with what we're seeing.
Last Wednesday, I went to New York and Dallas last week, busy week. But I was in New York live from the stock exchange. Did closing bell. I pointed that out. And thanks to you. And I pointed that out and listen, some people mocked it on social media. We saw some of that. And then Thursday we come in and off to the races. What's interesting also about last week, and we talked about it, I think we did, but big drop on Monday, big rally on Thursday, exactly flat on the week. Like the S&P was down 2 points. And you come in on Monday, the S&P moved a total of 0.00%. Okay, so you're flat on the week. I mean, just imagine telling someone that. Sunday night, if you told me Sunday night stocks are going to finish down the S&P is down 2 points, which is just a rounding error. Let's call it 0.00. Oh, by the way, and then Monday is going to be 0.00. I don't think anybody in their right mind, because you have to be crazy to think that was true when you look at those headlines, would have expected that. All right, Sonu, we kind of hit the end. As usual, we didn't have much of a script, but we filled up plenty of airtime. Hopefully people like this. What are you watching? What should we be paying attention to going forward?
Fed. I mean, right now, I think between now and September, you and I are going to be at Excel, so I'm looking forward to catching up with you, if not earlier, maybe hopefully sometime this week, if I can get down to Cincinnati. But the Fed. I think Jackson Hole will be key because markets are right now pricing in a 50% probability of a 50 basis point, 0.5% cut in September. I don't think the Fed is there. Goodness, one or two Fed governors are talking about, we don't even think it's ready. It's time to reduce rates even 0.25% in September. I'm like, going back to that whole inflation expectations. They're like, what are they looking at? Come on. I mean,
and that was, again, in our mid-year outlook, our biggest worry, our largest. Well, I mean, you could say a black swan event or some major war would be a big, but the ones that we can kind of see potentially coming with a little higher probability would be a Fed policy mistake. And again, I know this is super early. Market opened 15 minutes ago. I mean, S&P's up almost 1%. Okay, and I know who knows where we go on Tuesday, but it's just a realization that the worst is over from last week's Volmageddon Part 2. PPI came in pretty good. Now, listen, tomorrow, when most of you listen to this, probably CPI will have already been out. We anticipate that probably being okay. We'll see. That's going to be a big mover. But also, like you said, the Fed. And by the way, Excel is our very large conference we have once a year. This year, it's in Orlando. It's September
11th to 13th.
11th through 13th. Yeah. So it's coming up soon. And I think we can release this because it's public knowledge. Episode 100 of the Facts versus Feelings podcast will be live streamed live from Excel on stage. Sonu and I will be the very first morning. There's a couple things and a break. We're coming out on stage with our good friend Tom Lee over at FundStrat, which would be great. We'll play that replay later on this very podcast. We're going to live stream that. I'm sure there'll be more information on how you can watch that live. Honestly, just follow our social media handles. We'll get you that stuff. But that's going to be so awesome to chat with Tom on what he sees out there. We're such fans of Tom. So again, we've probably hit the end of the road. we've come a long way. There was a lot of fear, a lot of worry out there. Does not mean we're out of the woods yet, but I think we'll all take it, given what we were all thinking 8-9 days ago right now, and where we are. Obviously, we're watching the Middle East very closely, because by the time people hear this, it could be a lot different what's going on out there. But we wish everyone in the path of that potential issue, war coming, to just stay safe and be as well as you can. And with all that, everyone, we're here. Continue to follow us, carsongroup.com/research. Continue to follow this very podcast. We continue to get let's see, it's Facts versus Feelings. Versus is VS. Facts versus Feelings at carsongroup.com is our email. We definitely been getting some emails from people. Please continue to send our emails. Let me know how I should deal with Avis. I'm just going to call him, actually. I mean, I don't know what to do. Like, I dropped the car off on Friday. You did. Oh, the other thing, it said only went 100 miles. I'm like, of course. I drove the thing to Stephenville from Dallas. Like, that's more than 100 miles. So anyway, I'm gonna have to battle this one.
Maybe it's a wrong car or something.
Oh, well, trust me, it was the wrong car. I mean, I should never have an EV. It was the wrong car. That's not for me. It's just not. Maybe in a future, Ryan, but not for my first time driving an EV all around Texas. I don't know how to charge a thing. How do you plug one of those in? I don't know. Anyway, all right, everybody. Well, thanks for being here, Sonu. I'm sure we'll chat very soon. Hopefully, I get to see you here soon. Yes. Enjoy the great state of Ohio and enjoy the tennis tournament. You're going to the tennis tournament. We'll talk about that. Let's sign off with that. I'm going to say goodbye, everybody. What are you doing at the tennis tournament? We'll sign off.
I think I'm going. Hopefully, I get to see Djokovic and Alcaraz and the whole crew, and so now I'm pumped about that. One thing, if you don't know about the Cincinnati tournament, it's much more closed than something like the major, like the US Open or something like that. So it's fun to go early and see the practice matches, right? Because then you get really up and close and personal, and they're literally right there practicing and cursing and things like that. So it's a fantastic tournament.
Well, have fun there. And it's not as hot as it was last week. All around the country, I think it's a little cooler than it was last week. So that's a good thing. So with all that, episode 97 is in the books. We're inching closer to 100. We'll be back next week to do it all again. Everyone have a great week. We'll see you then. Take care, everyone. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.